Imagine the gut-wrenching regret of watching your retirement savings soar again after you've already panicked and dumped everything into cash. That's the colossal blunder many Aussie superannuation enthusiasts are committing without realizing it. Financial gurus consistently highlight that the top remorse among super fund members isn't plunging into investments during a market plunge, but rather bolting to cash far too hastily. As we edge toward potential market turbulence in 2026, fueled by inflated asset prices, political instability, looming recession risks, and even an AI hype bubble that could deflate returns, the stakes feel higher than ever. Duncan, Vanguard's head of investments, shared with Newswire that while both super contributors and general investors might feel the strong urge to do something drastic, staying put is often the smartest move. When markets hit peaks and start showing some turbulence, that itch to intervene becomes almost irresistible, he explained. But here's where it gets controversial. Truly savvy investors, in my view, stick to their guns and remain steady. And this is the part most people miss. Burns emphasizes that inaction might seem effortless, yet it's one of the toughest feats for investors, particularly when markets jitter and news outlets are blasting alarm signals. It's only natural for people to crave protecting their nest eggs by shifting to cash, but this instinct can lead to the gravest financial misstep. As he puts it, research widely agrees that a loss stings about twice as much as an equivalent gain brings joy, making that dash to cash incredibly alluring as folks seek refuge from volatility. Regrettably, outsmarting the market's timing is far tougher than it appears, with historical records revealing that the stock market's darkest days are frequently trailed by its brightest rebounds. Burns notes that the vast majority of those attempting to pinpoint ideal buy and sell moments end up misjudging badly. But what does this mean for everyday Aussies? Most hold some portion of domestic or global shares via their super plans. For instance, in a standard balanced fund, which combines growth and stability for beginners who might be new to investing, allocations typically range from 41% to 60% across Aussie and overseas stocks. Opting for an all-growth or high-growth approach, you're looking at least 80% of your retirement pot tied to equities. Even the more cautious, conservative options include a minimum of 21% in shares, illustrating how widespread exposure really is. Mano Mohan Kumar, head of super investments at Chant West, cautions in a Newswire interview that super should be treated as a marathon asset, not a sprint. You have to watch out for distractions from short-term buzz in the bigger picture, he advised. Knee-jerk choices can sabotage your long-term goals. Take the scenario of someone offloading shares after a dip. Not only do they cement the loss by exiting at rock bottom, but they also forfeit the subsequent recoveries. To illustrate, imagine the GFC crash of 2008 to 2009. Those who sold then missed the roaring bull market that followed. Mohan Kumar points out that super funds have experienced only 5 negative years overall, thanks partly to diversification. It hasn't been a flawless journey. Think the tech slump, the global financial crisis, and the COVID upheaval, but generally, stock markets and balanced portfolios have delivered solid results, he said. Now, turning to 2026, Shane Oliver from AMP's investment strategy team outlines key threats to local and global shares: overpriced valuations, fears of an AI stock frenzy with heavy U.S. reliance, uncertainty on central bank rate cuts in places like the U.S. and Australia, potential fallout from Trump's trade policies, ballooning public debts in various nations, and persistent global tensions. Yet, Oliver swiftly adds a silver lining: despite these concerns, 2026 could still be a decent year for markets. Optimism stems from central banks nearing the end of interest rate reductions and Trump's possible shift toward policies favoring consumers before midterms. That said, he predicts a slowdown in stock gains after 3 strong years, estimating global and Australian returns at about 8% ahead. Meanwhile, Morningstar observes that Aussie shares are now more reasonably priced following November's dip. The sell-off has made Australian equities far more attractive, their analysis states. Looking at sectors, there's a big split. Banking giants like the Big Four are still pricey, trading at nearly 30% above fair value on average. But beyond that, there are heaps of undervalued opportunities waiting. This raises an intriguing debate: is staying invested through the noise always the wisest path, or could there be rare instances where cashing out pays off? Do you agree that timing the market is a fool's errand, or have you seen strategies that work? And here's a provocative twist: what if the long-term view is just a way for funds to keep you invested at their benefit? Share your opinions and experiences in the comments. Let's discuss whether this advice holds up in the real world.